Welcome to the Ellsworth Advisors monthly update for January 2025. I'm Kelly Keenan. This is Cameron Mealy. Today we will discuss the latest economic news, discuss how our portfolios have done year to date, and kind of our expectations moving forward. Cam, kick us off with some economic data.
Thank you, Kelly. Good morning, everybody. Hope everybody's well. Over the last month, we've had two pieces of data come in that are relevant to our discussion today. On January 29th, the Fed announced that they're holding the Fed funds rate constant at 4.25 to 4.50. That wasn't a big surprise to anybody, but just confirmation that the Fed does see the fight over inflation is still ongoing. We also have on February 1st, the announcement that President Trump was going to implement tariffs, 25% tariff on all goods imported from Mexico, 25% tariff from all goods imported from Canada, and a 10% additional 10% tariff on China. Now, in response, both Canada and Mexico declared that they were going to implement their own tariff plans, then quickly reversed course, and there's now a 30-day pause on those tariffs. Really, President Trump's motivation here was he wants to secure border and he wants to stop the flow of fentanyl into this country. I don't think, those two goals need to lead to a trade war. This seems like something that any sovereign nation should want. And, Trump he knows how to carry the bully pulpit. And so we'll see how this plays out. Going to the numbers, gross domestic product on January 30th, Bureau of Economic Analysis reported that according to its advanced estimate, GDP in the fourth quarter increased an annualized rate of 2.3%. This is a decline over the third quarter, which was an annualized increase of 3.1%. And for full year 2024, GDP increased at 2.8% based on that advanced estimate. Very healthy GDP. We're used to.
A year ago, nobody would have guessed.
Nobody would have guessed.
We had that kind of year. So it was, GDP is solid, that's for sure.
Yeah. And to carry that forward, as of February 5th, the Atlanta Fed, their GDP Now forecast model, is predicting first quarter GDP growth at an annualized rate of 2.9%. So certainly, from a GDP standpoint, the economy really seems to be humming. Unfortunately, with a humming economy, we're also seeing this inflation issue really remain persistent. So let's look at personal consumption expenditure index, producer price index, and consumer price index. Personal consumption expenditure index, this is quoted as the Fed's leading gauge or leading tracker of inflation. On January 1st, the Bureau of Economic Analysis reported the personal consumption expenditure index increased 0.3% in the month of December. For the 12 months ending December, the index is up 2.8%. So now going from July to December, we've had year-over-year increases of 2.5%, 2.3%, 2.1%, 2.3% in October, 2.6% in November, and now 2.8%. So a little bit of a concerning trend there. The Producer Price Index on January 14th, the Bureau of Labor Statistics reported that the Producer Price Index increased 0.2% in December. And on a year-over-year basis, the index is up 3.3%. So this compares to an increase in 2023 of just 1.1%. Let's look at the Consumer Price Index. On January 15th, the Bureau of Labor Statistics also reported that the Consumer Price Index increased 0.4% in December. This was after falling 0.3% in November. And on a year-over-year basis, the index is up 2.9%. So strong GDP, inflation not at the Fed's 2% target. And now, of course, this morning, today is February 7th, which means the January jobs report came out at 8:30 this morning. The U.S. added 143 non-farm payroll jobs, and the unemployment rate decreased to 4%. The Wall Street consensus estimate was for 170,000 jobs, 170,000 new jobs. So we'll see if that number gets revised. But telling there that we have a strong, what seems to be a very strong economy, but yet employment has been softer over the last several months.
Yeah, new jobs have been softer. The overall unemployment number has basically stayed the same. Wages, I think, year over year up 3.8%. So obviously that's adding to the inflation numbers. And inflation, like I've written about, that's one of the big things we need to keep our eyes on. Getting back down to 2 is going to take, that's the heavy lifting. The easy lifting is behind us. And I'd say there is not a trend right now. So we're kind of stuck, which the likelihood of the Fed reducing interest rates too much this year, or
I think
maybe they bump it once or twice.
maybe 25, maybe 50 basis points, but I can't see unless these numbers change dramatically. I don't see much of a change other than that.
Yeah, I could see them get us to 3.75 or 4% on the Fed funds. The yield curve is uninverted. 10 years been, kind of hanging around that 4.5 area. We were as high as 4.8, now we're 4.4 today. But I think we're going to stay in that range. Anywhere between 4.5, 5.5% is where rates. That's where the longer term rates are going to be. Short term rates, I think, are going to be stuck here until you see that trend downward and inflation come down.
And certainly, we don't see anything right now that even hints at a potential recession out there.
There was a little bit of a scare early in the week.
This is the part where Kelly tells me I'm wrong, by the way.
There was a little scare early in the week. I mean, that was part of the freak out with the tariffs. Tariffs are going to be inflationary. There's a lot of mixed data on the inflationary effects of tariffs. That's a reality. Obviously, they could be a little bit transitory when we're talking about our neighbors of Mexico and Canada. I mean, that was a pretty quick reversal in the tariff war going on in our continent. So how long those stick around? And the other reality with tariffs is they are definitely inflationary if you have a lot of fiscal stimulus. So that's kind of those two. If they're both coming, that's a problem. Do we have any additional fiscal stimulus than we had last year? Maybe tariffs don't have the inflationary. That jury's out. So the Fed kind of pumping the brakes. It gives them an excuse to kind of wait and see. That's fine.
Well, and you know what could be inflationary, which is something we've not dealt with before. I saw today on Fox Business that already 60,000 federal employees have accepted buyout offers. And the standard buyout offer is 8 months of salary. So you could have a lot of federal employees suddenly without work, but with fresh dollars in their pocket, which could lead to additional spending, which could be inflationary. Again, this is when Kelly tells me I'm wrong.
You think about that. It's if they weren't laid off, they're not going to replace the jobs, so that money was already going to be spent. So that really doesn't raise.
But it's in their pockets today, now. Just like COVID, you get money in your pocket. We're Americans. We like to
I
spend.
think the government's going to pay up front, or will they pay monthly?
It says that they're paying up front.
Well, we'll see how that plays out. Who knows? The jury's out. I don't see the Fed do anything on interest rates because of inflation. And inflation, you have the wage pressures up.
In 6 months, we'll tell everybody who was right between the two of us.
Yeah, energy, if opening up drilling and everything could bring energy costs down. So you have a lot of offsets going on. But, we'll see where the overall trend is going. Let's talk about the markets.
All right.
See what's been going on here year to date. End of the year, obviously we had a lot of volatility last year. This month, started the month off, 2 weeks ago, we had the AI market freak out when it turns out that Chinese tech company found a way to do AI a little cheaper than the U.S. companies are. So that kind of a little shot over the bow over to big tech, which, we were affected a little bit by that. But that, kind of settled down. And then this week we roll into the tariffs, which freaked out the market. And now looks like the market's past that the last couple of days. Volatility is going to be the name of the game this year. S&P for January was up 2.7%. Dow Jones up 4.7%. NASDAQ 1.64%. So kind of the Dow Jones leading the pack year to date so far. Russell 2000 small cap stocks up 2.5%. The MSCI EAFE, so international stocks, developed world up 5.21%. And if you recall, the end of the year, international stocks definitely took it on the chin.
Yes, they did.
They had it looked like they were going to have a good year going into fourth quarter, and that did not happen. Obviously, they're making up some ground here last month. Emerging markets up 1.66%. And then talk about bonds, the aggregate bond index up 0.53%. So once again, tech has been a little bit challenged, and that's why we're starting to see some outperformance on the Dow or in the Dow, and a little bit broader participation. Our growth with income portfolio last month up 1%. Big gainers, Raytheon was up 11%, Nucor was up 10%, Visa was up 8%. Laggards for the month, NVIDIA, we talked about the AI freakout, down 10.6%. It was a lot worse than that at different points in time last week, but it's kind of trying to find its footing. Microchip Technologies down 5%, Lennar down 3%. In our dividend yield portfolio for the month, up 1.5%. We have done a lot of repositioning. Typically, we don't do a lot of trades in this portfolio, but over the last month or so, we've had several changes. Big gainers in January, AEP up 7%, Darden Restaurants up 5%, Johnson & Johnson was up 5%, Laggards, General Mills down 6%, Packaging Corp down 6%. Our appreciation with income portfolio for January, big month, up 4.5%. Meta was a big gainer, up 18. Lam Research up 12%. JP Morgan up 12. And our laggards, AES down 15%, and Broadcom down 5. Price potential, showing some signs of life here. We struggled this portfolio last year, and for the month in January, up 3.4%. Big gainers, we sold into it with a 55% gain. Arch Capital was up 20, Barker Group up 20. What we still have in the portfolio, Kinross Gold was a new position we put on last month, up 22%. Meta up 17, Rambus up 17. We did sell Skechers, which we didn't hold for too long. Made 12% in there, and today they got whacked down about 10%. So good thing we're out of that. Laggards, Dell was down 10%. Once again, NVIDIA down 10.6. Genrock, which we did sell earlier, I think we sold last week, down 4%. In our small cap portfolio, Pegasus Systems up 16%, Electromed up 16%, Northwest Bank up 10%. And then Natural Grocers was acquired by Vitamin Cottage. They were up 10% through the acquisition. Laggards, Hawkins down 13%. Esprit Manufacturing down 6%, and Employers Holdings down 4%. So starting off the month on the SMID was only up 0.3% for the month, so kind of a laggard there. So off to a good start. Making my way through some of the volatility, and like we talked about last time, I think it's going to be a positive year, but it's going to be choppy. We're going to see some healthy pullbacks. I think several in the 5 to 8 range, and at some point I think we're going to have a 10%er at some point through the year. But I like how we're positioned. End result, I still think we're making money by the end of the year.
It wouldn't surprise me. And obviously, with what President Trump has done over the last 2 weeks, Republicans, once again, don't like Democrats. Democrats, once again, don't like Republicans. There's going to be a lot of political noise out there. And obviously, President Trump is someone who, is out there in the media. As I said, loves to use the bully pulpit, loves to use social media. I think sometimes says things that maybe his advisors wish he wouldn't say. All of that is going to lead to some of the volatility, some of the headline risk noise. But at the end of the day, the U.S. economy is in.
That was another point. When we look at the market, the big 7 stocks that are kind of driving the S&P, and obviously the NASDAQ, more tech-oriented, the largest companies, their valuations have become very rich. They're called overvalued, very high valuation measures on them, even to the point where higher than even the dot-com days of Microsoft, Intel, Cisco, that hot pack back then. But even, high valuations don't cause a stock to go down. But what the high valuations do is they do make stocks more susceptible to short-term news. And that's where, when you look at the indexes, anytime we have adverse news, whether it's macroeconomically or sector specific, that could be a little adverse. If the companies are overvalued, those stocks are going to get hit the hardest and the quickest. So that's going to drive some of the heightened volatility, is because of where valuations are at, especially in that tech world at this point in time.
So happy February. Hope you have a great month. We'll talk to you again in March. Obviously, if you need anything, please let us know. Thank you, as always, for your trust in Ellsworth Advisors. Have a great day.
Thank you.